Navitas Semiconductor is trading live right now at $27.12, climbing a massive 9.09% in today's active trading session. While everyday retail market participants are obsessing over the multi-trillion-dollar semiconductor behemoths, a silent institutional capital migration is taking place right beneath the surface. Smart capital is realizing that the main bottleneck in the next leg of computing buildouts is not just raw algorithmic processing capacity, but the physical limitations of electrical engineering at the power grid and chip level. This sudden intraday surge is directly tied to newly revealed high-voltage direct current power architecture designs that completely bypass traditional electrical bottlenecks. Investors who look at a standard online trading platform or log into their personal brokerage account might see Navitas as just another speculative small-cap chip designer, but the reality is that the structural design of processing centers is undergoing a massive architectural shift that places wide-bandgap materials at the absolute epicenter of infrastructure design. The common expectation among retail investors looking at various investing sites is that Navitas Semiconductor is merely a secondary play on consumer electronics, struggling to maintain its footing in a market dominated by legacy silicon providers. For a long time, the narrative surrounding the stock was wrapped up in its exposure to mobile phone chargers and low-voltage consumer equipment, which made its revenue streams look highly cyclical and dependent on consumer spending habits. The general consensus was that it could never scale efficiently enough to compete with multi-billion-dollar silicon giants. However, the reality completely challenges this outdated perspective. The company has executed a massive strategic pivot toward high-power infrastructure, completely transforming its market profile into an indispensable component of next-generation infrastructure design. By focusing on both gallium nitride and silicon carbide materials, they are attacking the energy inefficiency problem from two entirely different angles, which has caught the attention of large institutions utilizing interactive brokers' trading platforms to build substantial long-term positions. When you look at recent trading volumes and daily swings, the massive capital flows become impossible to ignore. Navitas has experienced intense institutional accumulation over the past several weeks, with trading volumes spiked far above its historical daily averages. This surge in market interest has driven the stock to impressive new highs, as asset managers shift capital away from overvalued legacy software companies into hard infrastructure providers. The broader macroeconomic environment, filled with persistent inflation concerns and changing interest rate expectations, has forced investors to look for businesses with tangible technological advantages and real pricing power. As a result, users of self-investing platforms and advanced fidelity trading platforms have been aggressively adding this ticker to their portfolios. The stock has been displaying highly bullish technical patterns, breaking out of its previous consolidation zones with strong support from high-volume trading days, which indicates that this is not just a brief retail-driven momentum spike, but a coordinated institutional repositioning. To understand why this momentum is building, it is necessary to examine how the broader semiconductor landscape is shifting. For decades, traditional silicon has been the undisputed king of the electronics world, but it is rapidly hitting its physical limits when subjected to extreme voltages and thermal stress. This is where wide-bandgap materials like gallium nitride and silicon carbide step in, offering the ability to handle significantly higher voltages and temperatures while minimizing energy loss. Navitas has managed to integrate these materials into unique power-integrated circuits that consolidate control, drive, and protection features onto a single piece of hardware. While larger competitors are still trying to adapt their massive silicon manufacturing facilities to accommodate these new materials, Navitas has spent years perfecting its fabless model, allowing it to remain incredibly agile and rapidly deploy new designs directly to infrastructure clients who are desperate for energy efficiency gains. This technological edge is why many long-term investors are bypassing standard retail options and using interactive brokers' platform accounts to secure shares before the broader market fully prices in this structural transition. If we look closely at the financial performance over the past few quarters, the numbers tell a fascinating story of a company caught in the middle of a major operational transition. In its most recent earnings report, Navitas posted revenues that beat consensus estimates, driven largely by a 50% sequential growth in its high-power infrastructure segment. This growth acts as a powerful validation of their strategic shift away from low-margin consumer electronics toward high-value data center and grid applications. Despite reporting a net loss due to heavy research and development investments and long customer qualification cycles, the expanding gross margins indicate that the business model is inherently scalable once production lines reach full utilization. Institutional analysts have been quietly revising their long-term growth models upward, realizing that the company's addressable market is expanding at a much faster rate than previously anticipated. This fundamental improvement has caused a noticeable shift in sentiment across major investing platforms, with retail traders utilizing the Robinhood app and active investors on the SoFi trading platform increasingly discussing the stock's long-term upside potential. At this point, it is incredibly valuable to gather real-time perspectives from the investment community to see how individual portfolios are navigating this fast-evolving chip market.
market. Comment below how many shares of Navitas Semiconductor you currently hold, or if you are looking into alternative options in the power management space. Hearing how different traders balance high-growth small caps against the broader market trends provides a fantastic look into modern market psychology. Taking a step back to look at what the company actually does, Navitas Semiconductor operates as a pioneer in the next generation of power electronics, focusing exclusively on replacing legacy silicon with advanced wide-bandgap materials. Founded in 2014 and headquartered in California, the company's core business model revolves around designing and marketing proprietary gallium nitride power ICs and silicon carbide discrete devices. Their technology allows power supplies to become significantly smaller, lighter, and more efficient, which is absolutely critical for modern energy-hungry systems. Historically, the company achieved its initial commercial success by integrating its technology into fast chargers for smartphones and laptops, working with major global consumer brands to prove the reliability of their manufacturing process. While those past reports and legacy consumer products provided the initial revenue foundation, the management team recognized that the real future of the company lay in high-voltage industrial applications, leading to the aggressive development of their high-power infrastructure portfolio that we are seeing deploy into the market today. This foundational transition is critical because the electricity demands of modern computing centers are reaching unprecedented levels, threatening to overwhelm localized power grids. Standard silicon-based power components generate immense amounts of waste heat and suffer from substantial energy dissipation during the conversion process, requiring massive, expensive cooling systems just to keep the servers running safely. By utilizing gallium nitride in rack power systems, infrastructure operators can significantly increase power density, allowing them to deliver more electricity directly to the processing units without increasing the physical footprint of the power supply modules. Furthermore, Navitas has recently introduced breakthrough 20 kilowatt and 10 kilowatt power delivery boards that completely eliminate traditional intermediate conversion stages, allowing high-voltage direct current to flow straight to the core processing architecture with minimal loss. This level of efficiency is no longer a luxury. It has become an absolute operational necessity for hyperscale facility managers who are fighting to keep their operational costs under control. Looking ahead, the future outlook for Navitas is defined by a compelling set of potential catalysts along some very real structural risks. The primary catalyst on the horizon is the continued rollout of high-voltage direct current infrastructure across global server networks, which could drive exponential revenue growth over the next several years, as customer programs transition from the initial qualification phase into full-scale commercial production. Additionally, their expansion into grid modernization and renewable energy storage solutions presents a massive secondary market that could insulate the company from any sudden slowdowns in the computing sector. However, investors must also weigh these opportunities against the risks, which include intense competition from massive, deeply entrenched semiconductor manufacturers who possess far greater financial resources and established distribution networks. Because Navitas relies on a fabless operational model, any disruptions within their third-party supply chain or geopolitical friction affecting global silicon wafer fabrication could negatively impact their ability to meet customer demand and pressure their path to profitability. When you weigh the current expectations against the emerging reality, it becomes clear that Navitas Semiconductor is no longer the speculative, consumer-dependent business that many investors still believe it to be. The market's old narrative is rapidly breaking down as the reality of a massive structural pivot toward high-voltage infrastructure takes hold. While the company still needs to demonstrate that it can successfully navigate long enterprise sales cycles and achieve consistent net profitability, its commanding technological lead in wide-bandgap integration gives it a profound structural advantage. The massive intraday price movement and surging trading volumes reflect a growing realization among sophisticated market participants that power efficiency is the ultimate constraint on the future of high-performance infrastructure. For long-term capital allocators monitoring the chip space, the real story here is not about the day-to-day volatility, but about the fundamental re-architecturing of the physical infrastructure that makes modern high-density computing possible. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.